All right, welcome everyone to Daily Mortgage Rates Live with the Mortgage Calculator. We're going to wait a few minutes to get started here so we can go live on all the different platforms and give everybody a chance to tune in as well. So, everybody just hang tight for us. Hope everybody's been having a great week so far. We can put the comments up when you tune in. You could drop a comment in the chat there. We got it displaying on the screen, so feel free to drop a comment in there while we wait. All right, good morning, Jennifer. Good morning, everybody tuning in. Got a great topic to go over here today. Good deep dive. Definitely going to be interesting to see today's rates as well. So, everybody just hang tight for us for 1 minute. Good morning, Christina. Good morning, Matthew. Good morning, Jason. Everybody tuning in. Appreciate everybody getting on early here. Adam, Deborah, shout out to everybody dropping comments in the chat there. Good morning, everyone. All right, it looks like we are live and good to go, so we can go ahead and get things started here. Go ahead and take the comments off there. Welcome, everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. This show, Daily Mortgage Rates Live, we do every weekday where we check out the current rates of actual programs that we pull up live, and then we do a deep dive into a different topic every day. Now, we are a correspondent lender that specializes in non-QM loans, so today's topic is really great, something that we use a lot, definitely a great tool to use when we need to use it, which is profit and loss loans. So we're going to have Jose do a deep dive into that here a little bit later, show some actual quotes for it and how we can use it to solve some problems. But before we do that, like we do every morning, we're going to go ahead and have Nick pull up the rates with our pricing tool, and we will look at the actual rates for today. So, Nick, let's go ahead and pull those up and check out what's going on today in the market.
All right, sounds good. Let me switch my screens and we'll get started. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. We have over 300 licensed loan officers, and we are licensed in 22 states for primary second homes, and we can do our business purpose DSCR investor loans, which are very popular in 44 states. So please get with one of our team members if you'd like a full loan estimate with a full breakdown. This tool allows us to quickly see the rates of our general programs and the APRs for our general programs. For today, it is April 18th, just after 11 a.m. Eastern. So most of our programs have live rates this morning. So let's use the tool and set up a basic scenario to go through our options. So we're going to set all of our demos today to a 400,000 loan amount, pretty common loan amount. We will set the LTV to 80% loan, 20% down payment. We will set the desired price to 99. That means we're going to ask the computer to find the best rate at one discount point in cost. Most of our borrowers are asking to buy down the rate a little bit, so this is the most common request. We will compare our conforming conventional programs. Then we'll go into our FHA programs, and then we will check out our non-QM expanded guideline programs where we have over 5,000 alternative income programs we can use, which P&L, the topic for today, is one of those options, of course. We can also do VA loans for our eligible vets. If you are eligible, let us know. Since not everybody is an eligible veteran, we don't do that live, but we would love to quote that if you are. And same with USDA, that's only for eligible property in a rural area that's USDA eligible. So if you do happen to be shopping for one of those, let us know. We'd be happy to quote it, but not everybody is. So we'll stick with these three examples we do every morning. So we'll start with conforming conventional. We'll do a purchase transaction, 30-year fix, pretty standard transaction. Primary occupancy, single family home, 1 unit, state of Florida, county Miami-Dade, that's where our office is. And we'll use a 760 FICO for all of our demos and an estimated 40 debt to income ratio for all of our demos. And let's check out our rates this morning. So looks like the rates have gone up just a touch from yesterday. Obviously, we see that. Hopefully, they go down here with some more news that we get today. We'll see. And later this week. Right now, the best option the computer found was a 6.625 rate for 0.875 discount point in cost for a final APR of 6.797. So it's important to key in on the APR. That always allows us to compare across programs. So we see our conventional programs right here at this 6.797 APR, slight bit higher than it was yesterday, but much lower than the last 6 months. So now if there's any reason our borrower, in this case, doesn't qualify for conventional, typically the next best option is FHA. FHA does allow a little bit more leniency on the credit guidelines and a much higher debt to income ratio we can use. So typically this is the next best option. We'll keep everything else the exact same, and that'll quickly allow us to compare APRs across the different programs. So looks like the best option the computer found, actually the second one here in the list, a 6% rate for 0.875 discount point in cost for a final APR of 6.598. So you saw the APR there for conventional was just a slight bit higher. In this case, FHA is just a slight bit cheaper here. Remember, FHA does have a upfront and yearly mortgage insurance, and they've recently reduced that. So these programs are very comparable. Definitely recommend our borrowers compare both options if they qualify for both options. In this case, in this example, the APR is actually a slight bit lower for an FHA program today for this exact scenario. Now, if our borrower, for any reason, can't qualify for conventional or FHA, perhaps they need a little bit more income to qualify. Often, many other lenders or banks don't have any other options. Thankfully, we have over 5,000 additional options beyond the ones we just went over under expanded guidelines, aka non-QM. So we'll set everything else up the exact same here for this scenario. But in this case, we have a new option, income verification. So for non-QM, we can select full doc, which is what we use for FHA and conventional. That's 2 years of tax returns, what everybody's used to. However, we typically choose this option to select a different form of income documentation. We have 1 year options, 2 year all doc options. We have asset options that don't even require income. It uses assets for those programs. We have business bank statements, have our investor programs, but our most popular program by far for a primary home is going to be a 12-month bank statement program. And that's going to be for our self-employed borrowers. Many times our self-employed borrowers for 2 years of tax returns have various write-offs and need to qualify with a different source of income. So in this case, we'll use their most recent 12 bank statements to determine a debt to income ratio here of 40 in this example, using their bank statements rather than their tax returns. So many times our self-employed borrowers can qualify where they would not otherwise qualify, or qualify for a much higher loan amount and the home they obviously want using these methods. So let's check out our bank statement options this morning. So it looks like the top option here, this one's actually a little bit lower. Second option, 7.375 for 0.75 discount points and costs for a final APR of 7.447. So remember the conventional programs were 6.7 something, I believe. So not even a whole point higher here for the bank statement options. So very comparable options. Definitely recommend our borrowers that maybe need a little bit more income, definitely ask for one of these quotes for one of these bank statement programs, and it's very comparable. Now, if you cruise down the sheet here, you'll see there's tons of different options at different rates and terms. Some of these may allow things like bankruptcy or foreclosure. That's one of the things with non-QM. There's tons of different options and programs that allow us to get around other issues that may come up. So please get with our team. They can navigate which one of these programs may fit best for you. Now, before we go into Jose's example, we always want to do our instant pricing here for our investment properties. So our final two examples are going to be for an investment property purchase. Same setup as we had before, 80% loan to value, 20% down payment. And this time we're going to compare our conventional conforming rates with our expanded guideline non-QM programs. Remember, FHA, VA, USDA, we can't use for investment property purchases, so we're simply going to compare these two options. First, we'll select conforming conventional, keep everything the same as our other demos earlier today. And let's check out the rates when we switch to investment property. Now, as I say every morning, remember the GSEs, the entities that offer conventional loans, have added additional price adjustments to investment properties. So the computer's unable to find a combination with one discount point. The best combo the computer found, a 7% rate for 3.25 discount points and costs, and a final APR of 7.251. If we go down the sheet here, many of our investors ask to go higher in the rate to lower the cost here. But even if we scroll down here to a little bit higher rate, this is a good option here, 7.5% rate for 2.375 discount points and a final APR of 7.722. Many times our investors want to pay less discount points. So conventional right now has a limit where unfortunately there's just no options there. That's where we love to quote our non-QM and give a great alternative option. So for our final demo today, let's go back to the quick pricer, select investment property, set it up exactly the same. And for the final example, we will use expanded guidelines, aka non-QM. And we will select our non-QM income option here first, which for an investment property, the most popular option by far is going to be our DSCR option. And that's because it requires no income or employment from the borrower. We're simply going to use the estimated rental income from the property to compare that to the mortgage expenses, the PITIA of the mortgage we're proposing. And that gives us our DSCR ratio. So a ratio of 1 or greater means the rents will cover the expenses. So the ratio is greater than 1. We have a ton of options for those programs. We even have options for a ratio under 1, which means the property doesn't quite cash flow, and we still have DSCR options for that. But to show the most options here, I will set a DSCR of 1.5, and we will set a prepayment penalty, which is standard for non-QM programs for investment properties. Our standard is always 3 years. That's what we always use for our demo. We can select 0 if we choose. That will limit the loan programs and cost much more. And we can select 5 years if we'd like, but that will also limit the loan programs. They don't all allow 5 years. 3 years is the most common, so that's what we always use for our demo here. So let's check out our DSCR rates this morning. So looks like we got some good options. We love the options in the 7s as we do every morning. A ton of different programs here in the 7 rates. The best option the computer found right now, 7.5 rate for 0.85 discount points and costs, and a final APR of 7.575. So on these DSCR programs, very comparable to the conventional, almost identical there. So definitely recommend our investors check these programs out. If you qualify for conventional, that's great. We can quote that. But these programs are much easier, and we can do multiple loans. Many of our investors will start 2 or 3 loans to refinance and cash out and purchase 2 or 3 more properties and so on and so forth. So these loans are much easier since they don't require any income or employment. And if we scroll down here, you'll see we have dozens, if not hundreds of options here with various DSCR ratios, various prepayment penalties, etc. So please get with our team. They'll find which one of these may fit best for you. Some of these with a little bit higher rate may allow things like short-term rental income for our investors out there looking for Airbnb type properties. So tons of different options here for our DSCR. Now let me switch my screen again and we'll introduce our deep dive topic for today. And that is going to be on our profit and loss loan. So on the quick pricing tool for every morning, we always do the 12-month bank statement loan, which is the most popular option. But many times our customers may not quite fit with that program for various reasons. Jose will probably go over the various reasons where we may need to get flexible. However, if we need that flexibility, that's where the profit and loss loans come in. We simply prepare a profit and loss statement for the business we're looking at. We back it up with documentation, of course, and we're able to determine a monthly income figure using a profit and loss statement. So typically for our self-employed borrowers, just like the bank statements, just a slightly different version of that to calculate income in a slightly different way, but still the same idea here. So if you're ready, Jose, I'll go ahead and pass it over to you and we can get into your demo.
All right. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Profit and loss loans are one of our favorite ones. We have some great success stories using profit and loss loans by newly minted MLOs to basically like the phoenix rise out of the ashes with a great closing in 21 days, right? We had a great one there where we had a denial from somebody else trying to force it full doc, and we closed it in 21 days. P&L over $1 million loan was this MLO's first deal. By the way, this is tonight's training topic, so those of you who are whetting your appetite here, so you know exactly what you're going to be able to do here. So first example here I have is for a primary purchase, 90% LTV. So look at these rates, right? Very good options here. You're looking at 8.75, actually has a lender credit. Here, let me see if I can make this a little bigger. 8.75 has a little bit of a lender credit, and you can buy it down all the way to 7.125. I think that's pretty close to the rates you were throwing out there on those conventional type investment loans, Nick. And this is P&L 90% purchase. So now we have a P&L, excuse me, my investment purchase with 15% down. So this, again, very good option. There is a little bit of a buy down here at 9.25. That is the least expensive option. But mind you, this is 85% LTV, no mortgage insurance, just like the primary purchase I just showed you was 90% LTV, no mortgage insurance. So here you have 9.25 as the lowest cost option and 8.75 as the lowest rate option that we can buy down and still be compliant. All right, so now we're going to throw down some cash outs. This is our highest LTV cash out for an investment. Again, this is 85%, by the way, which is the same rate that they do on a purchase for investment. So that is why their rates are a little bit higher. So if your investor absolutely needs that extra 5% LTV, then you would go for this option. 11% is lowest cost option, and you can buy it down to 10.25%. But now I'm going to show you the exam. If they want to go 80% on the LTV, look at how much better it gets now. You're actually looking at 9.125%, showing a credit, and you can take it down all the way to 7.875%. So these are four very good options here. And I'm sorry, I don't have a primary option for you on the cash out, but it's pretty much going to be the same rates you see here, only 5% LTV reduction. So really good options here, profit and loss. For a profit and loss, keep in mind what you need is they say CPA letter, but be aware that CPA is a generic term that they're using for either tax preparer or accountant or CPA. So if whatever option that you select for the loan, just confirm that they do not actually mean a licensed CPA. Most of them do not, and most of them will say it in their guidelines, but just be aware, whatever option that you select, that it doesn't actually require the P&L from a CPA, so that you don't get off on the wrong trajectory and thinking when you're going to close, all of a sudden they condition you for a CPA license.
Perfect. Again, great tool that we use. I think we got a question here, Nick. If anybody has any questions, feel free to drop them in the chat there. Looks like we only have one question there so far. You want to go ahead and take that question, Jose?
Yeah, really great question. I'm so glad, because it could be a little confusing, because we do require the borrowers to be self-employed. That is the requirement for profit and loss, self-employed. It does not mean that it has to be a business purpose loan, because for us, business purpose loans means they are closing in an entity, It could be an LLC. It could be a corporation. It could be a limited partnership. And they are not using any personal income. This is the most important point. They're not using any personal income of the borrower. What that means is the only one that will be applicable then of the income types is a debt service coverage ratio loan, also known as a DSCR loan, because in that loan, we do not use the personal income of the borrower. We qualify the borrower based on the gross rent generated by the property divided by the housing expense, and then they're figuring out for whichever program you've selected if they qualify, if it's a 1.0 or above, a 0.75 to 0.99, 1.25 or above, and so forth.
Okay, looks like another question here as well. Looks like 2 more questions popping in.
Okay, why does 90% have lower rates than 85%? That's because the 90% was for a primary purchase and the 85% was for an investment purchase. So there's always a lower LTV. Well, let's put it this way. There's a higher risk assessment for the investment properties, hence lower LTV and higher rate because of the higher risk associated with it.
All right, looks like we got some more.
I love all the questions. That means there's deals in the works. Your borrower can use it to purchase a single family residence. Actually, the examples I was quoting right now, the highest LTV example is for a 1-unit property. There may be a lower LTV for a 2 to 4 unit property, even if it's a primary. Again, it has to do with risk associated with the property type. But definitely, you can use it to purchase a 1-unit, which would be single family residence, townhouse, or condo.
All right. Seasoning
requirement for closing in an LLC. I'm trying to figure out that question, but let's try to answer it.
Seasoning, 2 different questions.
Yeah. So the LLC can be a brand new LLC. Keep in mind the LLC is holding title. The LLC is not the borrower. Keep in mind on the business purpose loans where they are closing in an LLC, the money for the transaction does not have to come from an account held by the LLC, as long as a borrower is tied into that LLC in one form or another, right? They're going to provide an operating agreement to show their percentage of ownership. So no seasoning requirement on the LLC. It just has to be active, and you have to be able to provide all the necessary documents to vet the LLC. As far as seasoning on title, that would have no bearing on the transaction. If you're closing in an LLC or closing in a personal name, season on title is totally just on its own, and it's going to be based on whatever the option that you've chosen. Some have 6 months seasoning to get a cash out refi, some 0, some 12 months.
All right. I think that is it for the questions then. All right. So thank you, everybody, for the questions. Again, great questions because it's a great tool to use, right? So what we'll do is we'll go ahead and wrap it up here. Again, we specialize at the Mortgage Calculator in non-QM loans, and this is one of the ones that we use pretty often. And so if you need a quote or want more info on these programs, you can visit us at themortgagecalculator.com, and we can pair you up with one of our loan officer consultants. As you can see with these type of programs, you need a loan officer consultant to walk you through these different options. We have over 300 loan officers. We are licensed in 22 states for primary residences and second homes. And then we can do business purpose loans, just like the DSCR loans we discussed today, in 44 states. So we can help you out. Visit us, themortgagecalculator.com, or send us an email, info@themortgagecalculator.com. Now, we do this show every weekday at 11 a.m. Eastern, where we go through the live rates and then do a deep dive into a different topic, just like we did today with the profit and loss loans. So hope to see you tuning in every weekday. Thank you, Nick. Thank you, Jose. Thank you, everybody, for tuning in, and we will see you tomorrow at 11 a.m. Eastern time.
Thanks, everybody.
Thank you, everybody.